A key theme for investors in 2013 is the thirst for high-yielding investments, and master limited partnerships certainly fall under that. I'm with Hal Washburn, CEO of Breitburn Energy. And you guys, your portfolio is positioned a little bit differently because you price it out in Brent. Explain to us what the difference is versus other MLPs.
Sure. So among the upstream MLPs, we're the only one that really has significant exposure to Brent. California is our largest oil producing state, and all of our California crude is priced against Brent. So we get world oil prices for our California crude. At this point, we have a great portfolio of long life assets. We're going to spend about $260 million this year developing those assets and focused almost exclusively on oil.
So why is there advantage pricing out in Brent?
Well, California has no pipeline connections and really limited rail connections with the rest of the United States. So all the barrels that aren't produced in the state come in on tankers. So they basically are coming from foreign sources, so they're priced against the world oil market, which is Brent.
So talk to us more about the composition of the portfolio and the assets that encompass it.
So we're very evenly balanced between oil and natural gas. We are moving more toward liquids, though. We'll actually grow our oil and liquids production about 40%, just under 40% from the fourth quarter of last year to the fourth quarter of this year by focusing on oil drilling opportunities. We'll drill about just under $90 million worth of oil wells in California, just under $100 million worth of oil wells in West Texas. So over the course of the year, we will grow the oil production pretty significantly. Natural gas production, we won't spend a lot of our capital on natural gas this year. In fact, we'll spend, I think, less than 5%, probably less than 1% on the gas side of the business. Speaking
of capital, despite all the technological advancements, it is very expensive for oil and gas exploration companies. So what are you doing in terms of managing that and hedging?
Sure. So first off, to be clear, we don't explore. So we are an acquire and exploitation company. So while we drill a lot of wells, we'll drill 135 wells this year, we won't drill a single exploration well. So all of our drilling will be low-risk development wells, wells that are within the existing field boundaries that are designed to develop existing reserves. So it's a much lower risk proposition. We don't expect to drill any dry holes in our portfolio this year. We've been doing this for 25 years. We've been in the business for a long time. That differentiates a lot from our peers, differentiates us a lot from our peers, and it gives us a lot of experience. And so we're able to mitigate the risk of, kind of a high capital intensive industry because of a strong quality operating team and some great assets. So we feel good about where we are. We hedge a great deal of our production. We've got about 80% of our oil and gas hedged for the rest of 2013, 75 to 80% for 2014, and over 70% for 2015. So we take the commodity risk out of the equation through our hedge book.
Switching over to the balance sheet quickly, the coverage ratio came in a little bit lower than analyst expectations. What are you guys looking to do to increase that ratio going forward?
Sure. Well, it came in low in the first quarter, and we expected that. We had a lot of really out-of-the-market hedges that rolled off at the end of 2012, and so we now have a hedge book that's more reflective of the current oil and gas markets. We had some third-party curtailment and some wider differentials for natural gas liquids and some of our Rocky Mountain crude. However, with our capital program for the rest of the year, we expect to grow that distribution coverage ratio so that we'll have fourth quarter coverage ratio in the 1.1 to 1.2 times. And that's before acquisition. So obviously, if we make accretive acquisitions, then that'll grow the coverage ratio in addition.
And finally, let's review some distribution plans and plans for growth production going forward.
Sure. So we're committed to best-in-class distribution growth. Our target is 5% per year growth in distributions. We think that's very easily achievable for us through a combination of superior operations, deploying our capital efficiently to drill new wells, to develop new reserves, and then to make accretive acquisitions. We have raised our distribution 12 consecutive quarters since the first quarter of 2010 for a total of about a 27% distribution increase in that period of time. We're running at about $1.90. We're running at $1.90 per unit per year currently, and we're looking for continued 5% per year distribution growth.
Okay, thank you very much.
Thank you.